Okay, so we are going to discuss, actually, this is a continuation of the previous session. What is the agenda for today? Agenda for today is we are going to discuss the elements of financial statements, the 5 elements: income, expenses, asset, liability, and capital. I'm sure that you guys are familiar with these things, but I will give you a little bit of further understanding. We'll talk about the measurement basis recognition. Then very important thing before I start this course is I'm going to discuss with you the structure of 2 financial statements first: the statement of comprehensive income, which is your income statement, and the balance sheet. I'm sure that you people are familiar with that. You have been preparing your income statement and balance sheet from for a long time. But I want to show you, or I want to discuss with you, or I want to explain you that how the management is seeing, how the shareholders, they see the financial statements. I'm sure that you are going to enjoy that perspective of financial statements, like what is income statement? So these lines are there. What are these line items? Why do we put them there? What message do they give us? And if we talk about the balance sheet structure, so how to, it's not just about putting the numbers, it is just like, why these numbers are there and what message do they convey? So I'm going to discuss this thing, financial statement structure today. And then we will discuss the third section of our lesson will be regulatory framework. So 3 things I'm going to discuss. The first one is elements of financial statement. We call them 5 elements of financial statements. This is called asset, liability, and equity, income, and expenses. And you know that these 2 are the first 3 ones. They help you to prepare your statement of financial position, which you also call balance sheet. And they help you to make your income statement. Now, whatever accounting transactions may take place, everything will be within these 5 elements without any exception. So everything has to be either it is an asset or a liability or equity or income or expense. Now, the question is that what is an asset? We know that there is a definition of an asset, that an asset is a resource which is controlled by an entity as a result of past events, and which brings the future economic benefits. And then we classify the assets into current assets and non-current assets. Then within non-current assets, you've got, investment property, IAS 40, tangible non-current asset, we call it PPE, which is your IAS 16. You've got, then you've got inventories, IAS 2, biological assets, IAS 41, financial assets, IFRS 9. So you've got different right of use assets under leases, IFRS 16. So there will be different types of assets. And whenever we have these assets, what we are going to focus at, that when to recognize an asset, like it is your intangible asset, IAS 38. So recognition, the recognition principle, that if this is with me, can I recognize it as my asset or not? This is what we are going to learn. And then we are going to learn how to measure it, the measurement of assets under different methods, because inventory is valued on a different basis. Your financial instruments, financial assets are measured in a different method. Your PPE is measured on a different basis. So we need to learn different measurement basis for these assets. And then, of course, we talk about the presentation. More importantly is recognition and measurement. I'm sure that you guys know what is an asset, what is current, non-current. By the way, I asked one question here, if somebody could respond me. What is current and non-current asset? What is the difference between current and non-current asset? Give me some understanding. Anybody, please.
Current assets, it's quickly converted. It can be liquidated quickly, whereas non-current assets, it's a fixed type. Current is movable, or let's say quickly converted.
Okay, what do you mean by quickly? What do you mean by quickly?
Dilutable within a 1 year time.
Within 1 year. So what happens within 1 year?
Say like trade receivables.
Okay.
So
So
like
what happens to trade receivable within 1 year?
It will get converted into cash.
Converted to cash. So we actually see there, convertibility, conversion to cash. So one way of understanding this thing is that current assets are realized within the ordinary course of business. The current assets are converted to cash within 1 year. Even if they are not converted to cash, but they were expected to be converted. So, I mean, you might be having inventories for 2 years. You might be having your customers not paying you for 2 years, but that does not make it non-current. That remains a current asset. So one is that it is converted to cash within 1 year. The other way of thinking is that the benefit, because we say that asset brings benefit. If the benefit is received within 1 year, so I'm not calling it converted to cash. I'm saying that if you receive the benefit within 1 year, that is called current asset. Or if the benefit continues to come for many years, like you've got some property, plant, and equipment, you will use it for many years. You will get benefit for many years. So you call it non-current asset. So one way of seeing it, one dimension, convertibility to cash. The second dimension about the benefit. And there is a third dimension as well. The third dimension is that, you know, when a business purchases an asset, it gives out cash, okay? And you have to recover. You have to recover your amount. You have to recover your amount, this 100 plus some profit you want, because you will buy something. Probably you bought some inventory. Maybe you bought a non-current asset. In business, you don't put money. I mean, you want to take out money. So you probably are looking at 120 to take out. Now, the question is, how do you recover this amount? How do you recover this amount? With all the assets, you've got only two options. One option is use the asset. One option is sell the asset. If you choose, if you decide to recover your amount by selling the asset, it is current asset. This is what I call inventory. It is classified as inventory. But if you decide to recover your investment by using the asset, then it is under non-current asset. I give you an example. You've got a Toyota showroom. They bring Toyota cars from Japan. $30,000 car they bring in. They put $5,000 profit on it and they put it on sale. They want to recover their 30,000 plus 5,000, 35 by selling the asset. When they decide to recover amount by selling the asset, this Toyota car is now inventory. Now I purchased this car. I have no intention of selling it. When I went to Toyota, I purchased it for 35K. Who I am Avis Rent a Car. I also want to recover my 35,000 plus some profit, but I have no intention of taking out 35 by selling the car. What I'm going to do, I'm going to use it for many years and recover my investment over a period of time. For me, this is called non-current asset. So a third dimension, first dimension, we said that convertibility to cash. Second, we said, okay, benefit, or you can consider cash and benefit same. And then you say the method of recovery. So if you are recovering it by selling it, it is inventory, current asset. If you are trying to recover your amount by selling the asset, by using the asset, then it is your non-current asset. And I'm sure all of you people know IAS 16 PPE, property, plant, and equipment. You are using it. This is non-current asset. The moment you decide to dispose, the moment or the day you decide that I'm going to sell this property, I'm going to sell this equipment, I'm going to sell this vehicle, I don't need it in my business, I don't want to use it further. So you said I'm selling it. So actually, the word for selling a non-current asset is dispose. You sell inventories and you dispose of non-current assets. So you decide to dispose of non-current asset. The moment you decide it, you classify it under IFRS 5, and then it goes to inventory. It also becomes inventory, because before you were thinking of recovering your amount by using the asset. Now you say, I'm going to take out my book value or my amount by selling the asset. If it is selling the asset, this is inventory. Anyways, we will have many different standards on asset. Asset is just the beginning. We are just becoming, we are having an introduction. We will talk about tangible asset, intangible asset, biological assets, financial assets. All of these, we will discuss them separately as the time will come. And then we will also discuss their measurement basis, cost model, revaluation model, of course, fair value, and we will talk about impairment of assets. So a lot of things are going to happen about assets. Here it is just introduction. And then you've got a liability. Now, you know that a liability and asset, you can see them as antonyms, okay? These are kind of antonyms because in asset, the economic benefit flows into the entity, and in liability, economic benefit goes out of the entity. And by the way, I just want to clarify one thing with you people. We say economic benefit. So sometimes, now let's suppose I'm just moving away. I just want to explain the word benefit. So it has got nothing to do with this thing, but I just want to explain benefit. Let's suppose that you construct a house. You construct a house or a building, whatever, for 100K. And so this is your cost, okay? So this is your cost. And then your selling price, you sold it for 100K. Or let's call it, let me not call it 100K. You sold it for 90K. So what do we see here? We see there is a loss of 10K. Do we have any benefit here? Yes or no? Do we have a benefit here?
So here the question may come, how long we use that?
No, I have not used it. I just made it and I sold it.
Then yeah, it's a loss. There is a benefit. Benefit is there because it is sold and there is a transaction happen.
So how much is the benefit? How much is the benefit?
Benefit is we sold for 90,000. That is a benefit.
Perfect. 90,000. That is benefit. Exactly. You are right. Sometimes students, how to say, confuse profit with benefit. Listen, you did not make any profit, okay? You made a loss. That is very clear. But benefit is there because you did receive 90K. The asset, it gave you 90K. Now, your cost was more. That is another question. Maybe you wasted a lot of money. Maybe you spent something more. Maybe there was some loss. Maybe there was some stealing. I don't know. That's a different scenario. The thing is that the asset did give you a benefit. Asset gave you $90,000. Now, how did you manage your cost? That's a different thing. For example, if you work on a job and you get $1,000 salary, you come back home and you spend $1,200 and then you say that there is no benefit in working this job. There is a benefit. The company is giving you 1,000. Now your expenses are more. That's a different scenario. So first thing, what I wanted to make everybody on the same page, that benefit does not mean profitability. Benefit means inflow. So there was an inflow of economic resources. So whenever there is an inflow of economic resources, it is called an asset. And whenever there is an outflow of economic resources, that is called a liability. Okay. So we discussed asset, liability, equity. What is equity? The amount which belongs, the investment which belongs to the owners of the, to the owners of the business, to the shareholders. Generally, equity in your financial statements under IFRS, it has 4 line items. We call it share capital. I'm going to discuss them later, not now. I'm just putting them names here. Share premium, you've got retained earnings, and you've got reserves, okay? So there are 4 line items under equity. You should remember that equity is the money which belongs to the owners of the business. Equity is the residual interest. Equity, it is also called net assets, okay? Net assets and equity is the same thing. For example, when you say that total assets minus total liabilities, so this is called net assets, okay? And this is also called equity. Total assets minus total liabilities. So you've got assets of 100 million, you've got liabilities of 70 million, you pay off the liabilities, what is remaining? 30 million. This is what the shareholders can take home. This is what could be given to the shareholders. So that is called equity. We are going to discuss it in more detail later on. Then we've got income. What is income? Who will tell me income, please? Income. Yes, my friends.
That's any revenue or the inflow for the company, any revenue or benefit that company receives.
Okay, let's not call it revenue. Revenue is a very narrow word. You use the word benefit, right?
Yeah.
Yeah, because you yourself was not happy with the word revenue. Okay.
I think the benefit that accrues during the normal course of business operations.
Okay, let me just read the definition together and then I will explain you that what is income. The definition under IFRS, it says, income is increase in economic benefit, during the accounting period in the form of inflows or enhancements of assets. Inflows or enhancement of assets or decrease of liabilities. So inflow, enhancement of asset or decrease in liability that result in increase in equity. This is important. Other than those relating to contributions from equity participants. Now, what does that mean? We said that equity was 4 components: share capital, share premium, retained earning, and reserves. Any transaction which will result in increase of equity, other than capital injections, like which will result in increase in equity, is called income, other than capital injection. Capital injection means that by issuing share capital, you can increase the equity. One way of increasing equity is that you issue new shares. This is called capital injection. So other than capital injection, like shareholders are not putting money from their pocket. Other than that, any other transaction which will result in the increase in equity is called income. Let me just share with you something. Wait a minute. I'll see here. So can you guys see this Excel file?
Yes, sir.
Okay, so I just prepared, this is the same definition of income. Income is increase in economic benefits, etc. We already did. And this is a very simple balance sheet. Non-current assets, PPE, intangibles. Current asset, you've got inventory, receivable, cash. You've got here equity, which is 1,900. It is sum total of these numbers. Non-current liabilities, current liabilities, balance sheet, 2 sides are equal. So far, they are here. Now, imagine that if I say that inventory valued 100 was sold for 150 on cash. Maybe on cash, maybe on receivable, doesn't matter. So this is one transaction which took place. $100 worth of inventory was sold for 150 in cash. So what will happen? Your inventory will be subtracted 100 from here and cash will be added, 150 here. You have to add 150 here. So this will become 400 and this will become 450. So now if you see that because $100 inventory goes out, 150 cash comes in, asset side and there is a difference in asset and liability side. So I need to add somehow $50 here. Where I'm going to add $50?
Retained earnings.
In retained earnings. So in retained earnings will become 550. So equity increased. Before it was 1900, now it is 950. This transaction is called income transaction. Okay. But if I tell you that $100 inventory was sold for $100, $100 inventory sold for $100. Now what will happen? This 400 will become 300 and this cash will become 550. There is no difference. This is not an income transaction. There is no income here because income necessarily means that any transaction which will result in the increase in the equity. Imagine that you've got here, non-current asset was, let's call it like this, $200 non-current asset was valued to 300. So inside of this 1,000, you had some asset which was 200 in your books. Now it becomes 300. So of course I need to add 100 here. So this will become, 1,100. And then I need to add something here. So where should I be adding this 100? Into reserves, right?
Yes, yes.
This is again an income transaction. So income is enhancement of assets also means income. Now, if you have a liability, for example, supplier gave discount of USD 20. A supplier is giving a discount of $20. So I had this current liabilities 200. I need to make it 180. When I make it 180, because supplier has given me discount, so my current liabilities will go down. The two sides are not matching. So I cannot remove $20 from here. My PPE will remain same, intangible, inventory, receivable, everything will remain same. What will happen? That a discount received from supplier is also an income, and I need to add into my retained earning 570. This is also an income. So we say that income is either you are selling something on profit, that gives rise to income, or increase in asset, that is an income, or a decrease in liability, that is an income, or any other transaction which will result in increasing of this number. If your equity is increasing, it is an income transaction. The only exception is share capital. That let's suppose that you say that issued new shares for 300. So when you issued new shares for 300, what will happen? That your share capital will increase and your cash will also increase. Equity has increased, but this is not income, because this is the money which business has not generated, because this is the area which belongs to the shareholders. This does not belong to the business. This is the area which belongs to the company. Okay, this is company. All of that is a company thing. Let me just put it somewhere like this. This is business. Okay, this is also company. This is also business. This part, the red part, is not company. This is shareholders. So if shareholders are giving some money, that's not an increase in income of the business. If I talk about expense is exactly opposite of that. So where you write down the income definition and it says that benefits increase, which would result as increase in equity, you call it income. I just replace the word decrease in equity. That if equity goes down, any transaction which takes place and which results in decreasing of equity, that is expense, other than capital transactions, which mean that if you give out dividends, let's suppose that we say that gave dividends of $150, let's call it $200. You gave out dividend for $200. What will happen? Your cash will go down from 850 to 650, and your retained earnings will go down from 570 to 370. Equity goes down, but it is not income. It is not expense. It is not expense, because this time equity is going down because of shareholder transactions, because of capital transactions. Are we clear on income and expense here?
Yes, sir.
Any question you have?
Can I ask a question?
Yes, please. Please ask.
I need to ask some example is practically in my company. So we have accumulated previous depreciation, not deducted for more years later. Suppose 6 years. This accumulated amount 1.5. Now these days we have external audit says, why did you deduct this amount from from the return earning. I deducted this amount from the return earning. I says yes. I says to him because this is a previous mistake, or I think this is standard says that.
Yeah, you did it right. This is actually, I tell you. Now, there is one more thing I wanted to say about this scenario here. I'm going a little bit, I'm drifting a little bit from the topic, but I'm actually from the book, but we're remaining in the topic. See, we have seen it many times in mid-size organizations. Like I told you that I've been doing consulting, and I've seen it a lot of time in SMEs and mid-size organizations. Mid-size organization, I say, which is up to $400, $500 million, okay? A company which is valued around 400 to 500 million, it comes under mid-size. What we have seen that their assets registers are not properly maintained. Many times I have seen that you've got asset on the books, but there is no asset on the ground, or they have not been properly depreciated. They have been thrown away. For example, I'll tell you the real life thing. You've got computers, like 300 computers in your office. You've got 50 printers in your office. You've got 300 UPS in your office, and you put them in your books. And you keep on depreciating them at 20%, 25% straight line, whatever is your method. And then what happens that one UPS or one printer or one generator, some other small piece of equipment, it is actually broken down, you throw it away, and you bring a new one. When you throw it away, you don't remove it from the balance sheet. It had a book value of, say, $100. So you just threw it away, that it is not working, and you brought a new one. So your number of printers are again 50. But in the books, the value, because in the book you don't have single value in your computer system, many times you don't write it off. I have seen here, like, there was like, how to say, a lot of equipment accumulated over the time, which has not been properly cleaned away from the asset register, not properly maintained. In small and mid-size entities, I'm saying. Large entities are very good. Small and mid-size, it will happen. Then what will happen? One day you will sit down and you will say, let's do my asset tracking, and let's see what is missing on my site, what is missing on my production floor, and you will find out there are so many small pieces of equipment which are missing. When you make a total, it gives you a number, $1 million, maybe more. Now, where do you write them off? Everything. Remember, everything which belongs now. This is now one scenario, a real life. If I come back to the exam, in exam, what do? In exam, they say you that last year, the depreciation was not properly treated. The depreciation calculated was, 1.5 million. It should have been 2 million. So $500,000 depreciation was charged less in the last year. So you need to charge an additional $500,000 this year. What is the correct treatment of this $500,000? Where are you going to put this $500,000? Are you going to put it into your income statement? Or are you going to take it to the balance sheet? What is the answer? This last year balance sheet, which was undercalculated. What do I do with $500,000? Can anybody tell me?
I think like depreciation is a prospective treatment rather than a retrospective application.
So what should I do?
So this should be in the current year financial statement as per the IAS 8, I think.
No,
like
current year income statement or current year balance sheet?
It's basically it's a write-off is IAS 8 as per the prospective treatment. I think like it should be in the current year profit and loss account. But I think like IAS 8 it says that if it is anything which is affecting the current financial profit and loss account, that should be treated into the retrospective effect as well.
A little bit you are taking it away. Let me tell you. Yeah. When you prepare your income statement, yes, the income statement heading, it says income statement. for the period 0101 01 01 2020 to 31st 12 2020. The title say it all. The title tells you that it is from 1st of January 2020 to 31st of December 2020. All the transactions which have taken place within this period should be here. All transactions which have taken place within this period should be on this page. This 500,000 does not happen this year. Now,
Yes, yeah.
This 500,000 does not belong to this period. So I should not be putting it here. Now, my question is, this 500,000 was wrongly reported last year, right?
Yes.
So I should go and put it in the last year. But last year financial statements I already have published, I already have given, I cannot do anything about that. So let me see. This 500,000, if I had reported it last year, my last year profit would have been less, right? So I showed more profit in the previous period, right?
Yes.
Where is that profit now? Where is it showing now?
It should be in retained earning. Yeah.
It is in the retained earnings.
Yeah.
That is in the retained earnings. So this 500,000 should be treated into the retained earning. Always remember, all of your prior period errors, they should go where they belong to. I mean, if I had not made this error, my retained earning would have been different. So when I subtract this 500,000, so it means that this retained earning number, it is not correct. It simply means that this retained earning 370 is not correct because it includes profit from the last year, which was overstated. So let me correct it here and I will make it 369.5. Now my error is corrected. I will take it from here. Now, this is
what will be the next effect on the balance sheet. So once it is deducted from there, then
you have to
the other
decrease the
side
asset.
will be,
You have to
yeah.
decrease the asset. Debit retained earnings, credit asset.
okay, then net assets will, net value of net assets will be decreased.
My PPE is shown higher. My PPE book value is more. So 0.5 from here, 0.5 from here. So I would be doing it like this, 1100 minus 0.5 and 370 I have here, and I will take it 370 minus 0.5. Okay, so both sides I will subtract. Prior period errors, always remember, income statement is for current year. I cannot take, so this is one rule for everything, because in exam, they will create different scenarios. They will try to tell you long stories, swap it like this, switch it like this, twist it like that. They will make a lot of long tails. Bottom line is, income statement is for 1 year. Does this transaction belong to my current period? If yes, I will write it down. If no, I will take it to the balance sheet. So this area which you have here in the balance sheet, this is actually a dumping place for many things. A lot of adjustments are corrected here because you know that end of the day, everything belongs to the shareholders. So residual interest and everything. So all which you make adjustments in here, you make adjustments in here, you make adjustments in here. If they don't counter each other, they will be settled here. If you don't find a proper thing, you have to ultimately settle it into retained earnings or into reserves.
Basically, as per the IAS 18, it is saying that IAS 8, it is saying that the depreciation estimate is basically a prospective treatment rather than retrospective transaction.
No, that is what you are saying. It is not about the last year error. This is like which you are saying about accounting policy, if I'm changing accounting policy or not.
So it's basically, I'm talking about the estimate part. Estimate part as per the depreciation is basically.
No, there are two things. One is that I am calculating my depreciation by reducing balance method. And then I say, no, I'm not going, okay, for last 3 years, I use reducing balance. From now on, I want to use straight line method. Now that is a change in accounting policy or change in accounting estimate. So we call it, it is a change in accounting estimate. And it has to be prospective, okay? It is not retrospective, it is prospective. I agree. But in this question, I am not asking about what are we going to do in future. I'm saying we made a mistake in past.
Okay, I agree. For the rest, it should be in, yes.
If you change your accounting estimate, then depreciation is prospective. But here I'm saying that, let's suppose we identified a fraud. Let's suppose that in this year, you find out that last year, one of your salesperson has collected $1 million receivable from the market and he just left the job last year. The guy is no more traceable. But you find out that there is a theft which was done last year. So that's a loss, okay? I have to put it in somewhere. I have to decrease my profitability. Where I'm going to book it? Can I book my last year loss in this year income statement?
No.
Answer is no. They will give you 10 different types of scenarios and they will ask you what to do. Or they will tell you that this is a $1 million loss. Out of 1 million, 0.7 million belongs to last year. And so this is what you just found out, okay? So one of your guys who just collected cash from the market, $1 million, and he just vanished. Out of this 1 million, 0.7 million belongs to the last year and 0.3 million belongs to the current year. What are you going to do? The last year thing, 0.7 subtracted from the retained earning, because last year should have been adjusted in last year income statement. Where is the last year income statement? The last year income statement net result is shown in the retained earnings. So I'm going to put it there. This current year 0.3 I will write down here. Understand? Okay, Mohammed, I'm coming back to your question. If you had any previous period depreciation or any other things which you did not charge to your financial income statement in past, you only realize it now that there are some adjustments which we were supposed to make and we did not make, which belong to the last year. They cannot come into current year income statement because current year income statement starts with the revenue. That revenue is my 5 million. And this is the 5 million revenue in this year. And all expenses which I incurred to generate this 5 million revenue, I will write down. Okay. If I start writing down my previous year expenses here, they are not for this revenue. This is your revenue. And you need to make sure that you only write down expenses which are incurred to generate this revenue during this 1 year. Anything from the past, we don't put it here. If your auditors are asking you to put it into current year income statement, I don't know the full overview or the background, but I'm 90% sure that if you say that this is from past year expense, which we missed out, and he's asking me to put it into this year, don't do it.
Sir, an entity failed to.
Sorry?
What if an entity failed to capitalize an asset in the respective year and found subsequently, okay, this asset is not capitalized in the last particular year, but they
balance sheet transactions. Balance sheet transactions. Listen, your balance sheet statement of financial position is a permanent thing which stays with you. Income statement, it starts with 0 and it ends at the year. Next year, it again starts with 0. Income statement is not the holding place. Where are your assets? Your assets, they live here on the balance sheet. If you made any mistake in increasing or decreasing them, go adjust them on the balance sheet. Don't take it to income statement. Income statement is not for adjustments. Income statement is only for current year operations.
I hope he's saying that instead of capitalizing, he might have charged to expenses. In that case, it should be restated. Basically,
again, increase the retained earning, increase the asset.
Yeah, that's it.
Debit the asset and credit the retained earning. So whether you charged last year less or you charged last year more, anything which is related to past, Like I told you that there will be multiple scenarios. There will be 10, 20, like 2 scenarios I gave, 1 scenario you gave. Probably there are some other friends. Everybody will think of something. Rule is one. Anything which belongs to the past year, I will not put it into my income statement. Listen, if I am the CEO, if I am the director, because directors are responsible to prepare financials, I am giving this year income statement. Why would I take the last year expenses into it? Maybe I was not here last year. Maybe last year there was some other director running the company. I just came this year. And the last year director did not show his expenses, and you want me to take all that hit into my income statement? I will not, because I am responsible that I've worked. Income statement, what is the objective? I'm giving you the keys. Go and run the business. End of the year, you come in and I ask you, how much revenue did you generate? You say 5 million. And how much cost did you incur to generate this 5 million? And you say 4 million. Okay, 1 million is your profit. It is strictly for 12 months. Previous things, they go out.
Sir, suppose if the expenses is missed to book last year, and if we have to adjust that in the return earning, then what will be the corresponding effect in the asset side? I got quite confused in case of expense.
It is possible. It is possible. Now let me just make these numbers clear. Let's suppose that you had some suppliers invoice. You purchased something, you used it, and supplier invoiced. You missed. It happened in October, September. Supplier invoice was lost. And you never booked the expense and you never booked the liability. But your factory or your production, they did receive the goods and they used the goods. That is possible, right?
Yeah.
So in that case, what I need to do? I need to book the expense and I need to book the liability. But now already the new year has started. Is it my expense for the new year? It is not. So what I'm going to do, I'm going to increase my liability 100 from here, and I'm going to decrease my retained earning from here. Because last year, if I had taken this expense into consideration, my profit would have less. So I decrease 100 from here because last year profit is included in 370 and I need to decrease it. And the same corresponding double entry would be onto liability. So I would say debit retained earnings and credit payables. A lost invoice.
I got it, sir.
Clear?
Yeah, clear, sir.
So we just moved from Excel to here. We discussed this income expense and a little bit of, equity section and the adjustments to equity. Let me now just quickly go through it and finish it. Definition of income encompasses both revenues and gains. Now, when you say gain and revenue, and then there is a word profit, okay? So profit is something which you will make in the ordinary course of business. What is your core activity? If you earn something, if you make some economic benefit or increase in economic benefit by your core activities, that is called profit. But businesses, they do get economic benefits from other directions. Those are called gains. So for example, if you are a furniture manufacturer, so anytime and every time you sell furniture and there is an increase in economic benefits, that is your profit. But then you have money in your bank and you earn some interest, that is gain. You have some investments and your dividends are coming in, investment income is into gains. You've got here revaluation of non-current assets, that is gain. So all of them, they come under umbrella of income. They are income, but you classify them separately. Revenue arises in the course of the ordinary activity of an entity. Like I said, that revenue is the first line, sales revenue. What is in the revenue? Only your core activity. You are a construction company. In a construction company, you make some apartments and you sell. Every time you make apartment, you sell, that is your revenue. Now, you don't have many projects. You've got some construction equipment, which is lying idle. You are not using that equipment. And you know that construction equipment is very valuable. You give it out for rent. And you are getting monthly rent, $10,000, $20,000, $30,000. That is not revenue. That is other income. Always remember, revenue is only coming in from your core activities. If I get this money by renting the equipment, it goes into other income which is below your gross profit. I will show you the structure of income statement in some time, and then I will show you where you will report revenue, where you report other income, where you report other comprehensive income. 3 lines we have. Gains, I already have explained. Then you've got here expenses we discussed. You've got cost of sales, like the first part. Okay, I'm going to explain this thing when I will go to structure of financial statements. Let me just quickly go there. You've got cost of sale, wages, depreciation, admin expenses. You put them into categories and you show them. Now, where do you show them? I'm going to explain you in 3 minutes when I'll go back to the structure of financial statements. So just be patient. They usually take the form of an outflow or depletion of assets, etc. Losses, expenses. Losses are also which decrease in the economic benefit. A decrease in the economic benefit, losses, okay? Some kind of loss you make, theft, stealing, or any other losses. Recognition principles, recognition of the elements of financial statement, okay? That's very important. When do you recognize the revenue? When do you recognize the asset? It's very, very, very important. So recognition is the process of incorporating in the balance sheet or income statement an item that meets the definition of an element and satisfy the following criteria for recognition. Number 1, it is probable that any future economic benefits associated with the item will flow to or from the entity. So flow to, if it is an asset, so economic benefit will come to you. If it is a liability, economic benefit will go from you. If it is revenue, economic benefit is coming in. If it is expense, economic benefit is going out. And the item's cost or value can be measured with reliability. So 2 areas. Number 1, the economic benefits are probable. And when we say in accounting, the word probable means that there is more than a 50% chance of occurrence. Your probability of occurrence is more than 50%, you call it probable. And the cost or value can be measured reliably. If you can measure it with reliability, these are the 2 criteria. And we are going to use these 2 criteria for all of your assets except your financial assets. Financial assets is the only one which has some exception. When we will go there, I will explain that. Otherwise, whatever type of asset you have, you've got the same 2 criteria for recognition. Based on these general criteria, an asset is recognized in the balance sheet when it is probable that the future economic benefits will flow to the entity and the asset has a cost or value that can be measured. So we understand. A liability is recognized, again, the opposite of that, in the balance sheet when it is probable 50% that it will flow out of that, and you know the value of that approximately. Income is recognized in the income statement when an increase in the future economic benefit related to an increase in an asset or a decrease of liability has arisen that can be measured reliably. So income is also recognized when you can measure it reliably. By the way, revenue, you should remember probable. There is a word that you can measure it, and there is a word that there is a probability, there is a probable that it will come. So if I give an invoice to a customer, it is measurable. I know I can measure it. What do you think about this probability? How does this thing apply to revenue? To asset, I know that if I have a car and I will give it out on rent, and it is probable, more than 50% chance that this asset will go on rent and it will bring me some money, or I will use the asset and I will get some benefit. I understand. With revenue, what do you see with probable? What comes to your mind? I mean, the word probable also applies to revenue.
It's basically a realizable from the customers. There is no doubt on the money which we received from the customers by selling the product or services. That we can say the probable.
Great, great. I'm happy for that. You recognize the revenue when you know that the customer has the capacity to pay and the customer has willingness to pay. If I've given an invoice and if you have doubt that the customer is either not willing or does not have the capacity to pay, don't recognize it. You recognize it, the receivable, when you know these two things, capacity to pay and willingness to pay. And that is where you call it probable, because you know that this money will come to me. And that's why you are reporting. If you know that it is not going to come, why do you show it? I mean, that's very straightforward. Sometimes my accountant says, oh, this is the transaction, that's why I'm showing it. I say, if you knew that this customer is not going to give this money, why do you put it on receivable? Why do you come and tell me I've got 1 million receivable? You knew that this money is not going to come. So don't tell me that it is receivable, because if you are telling me that it is receivable, whereas in your heart, you know that this money is not going to come, you are probably misleading yourself and misleading myself. Take it away from the balance sheet. This money is not going to come. This is not my asset and this is not my revenue. Okay, anyways, we did this thing. IFRS framework acknowledges that a variety of measurement bases are used today to different degrees and in varying combinations in financial statements, including. So I'm going to discuss it very quickly here. I will explain these things when I will do assets. Individual, when we will do standards related to assets like tangible, intangible, and others, inventory, and biological assets or financial assets. We will discuss them later on. Historical cost is the cost at which you purchased the asset, the cost at which you acquired the asset. And that includes, I'll quickly speak the definition, you will listen. Historical cost of an asset, it includes the purchase price plus any other expenses which are incurred to bring the asset to present condition and location. Present condition means transportation and all other. Present location means transportation and all other. And present condition means installation and to put it in up and running condition. So in general, the money which you spend on the asset until it is ready for use, all that money, it goes to the initial cost of the asset. It is quite common that you purchase an asset. I mean, I'm telling you from my personal experience. I mean, a few years ago, we purchased some asset for approximately 16 million. The purchase price of the asset was 16 million. In my books, the cost I'm booking approximately 19.5 million, because 3.5 million were other expenses. So purchase price plus any other expenses which are incurred to bring the asset to working condition. Okay, so cost is a bigger thing than purchase price. You've got here current cost. Current cost means the market price, what is its current market price, how much it is in the market now. Then you have got net realizable value, NRV. NRV is actually, you call it that NRV is equal to selling price minus all expenses to sell and complete. So if I've got an asset which I can sell for $100, but for selling purposes, I need to have spent some $5 as my sales commission, some $5 for some asset improvement or whatever. So $90 is my NRV. NRV means that how much this asset will ultimately bring you. I'm selling it for 100, but I'm not getting 100, I'm getting 90. I give you an example. I'm selling my car. I'm selling my car for $20,000, okay? And the person who is selling this car, he says that you give me sales commission of $500 if I bring a customer. I said, no problem. You bring me a customer of 20,000, I'll give you 500. And then what happens? that a customer comes in and the customer says that I will give you 20,000 for this car, no problem, provided that you change the tires because these tires are very old. Bring me 4 new tires and I will buy the car. 4 tires, $125 each, 4 tires are $500. So after doing this thing, I get 19,000. Customer will say that I purchased car for 20,000, but I got in my pocket only 19,000. For me, the car had a net realizable value of only 19,000. You call it NRV. NRV, we use it for inventory purposes. It is used in inventory, okay? Then what you have, present value. Present value, it is also called economic value. We also call it economic value. We also call it value in use. So what is value in use or economic value or present value? You call it that it is the present value, discounted cash flow concept. It is the present value of the future cash flows generated by an asset. Cash flow, profit, not cash flow. Let's suppose I've got a car, and I can give this car on rent. And if I give this car on rent, it will give me $5,000 every year in cash. I'm not saying profit, in cash. I mean, I will have some inflows. I will pay my expenses. I've got 5,000 hard cash in my hand. The car has a life of 3 years. So it can give me 15K, but the 15K does not come in one day. 15K comes over a period of 3 years. I need to discount it. Now, how to discount it? I will explain it later. But we know that this 5,000, the 5,000, which is after 1 year, in today's term, this is only 4,700. This 5,000 is equal to 4,300. And this 5,000 is equal to 4,000. I mean, a 4,000 of today is equal to 5,000 of 3 years later, which means that what I can buy today for 4,000, the same thing I will buy for 5,000 in future. So when I make a total, it gives me 13,000. So this is the present value of the future cash flows. This is called economic value. This is called present value. These are the 4, valuation bases, which we will discuss. And of course, we are going, when we will be doing individual standards, we will be further applying these concepts while doing questions. Because by the way, I did not mention it. I've got some 40% time, 50% time on theory part, and more than 50% time will be spent on doing questions. So we will spend quite a lot of time. We will be doing last 3-year past exam papers, which means that 6 exam papers I will be doing with you in the class. Because without doing questions, you cannot learn how to apply these things. So we will be discussing these concepts many times in future as well. If you've got any question, please ask me until here. Okay. Okay, so you asked a question, very interesting, that current cost, is it like net realizable value? Can we say that net realizable value is current cost minus selling expenses? Answer is no. Let me first say NRV is selling price minus expenses to sell and complete. Now, what is current cost? There are 2 words for that. Current cost is also called replacement cost. Replacement cost means that the cost of an asset, a cost of a similar asset. Let's suppose this is my computer I'm using. This is a Dell notebook. I purchased it 2 years ago for $1,000. It's a used Dell notebook. Its historical cost was $1,000. But if I go into the market today and I want to buy, not sell, I want to buy a similar used notebook, they say it is $500. So I got here current cost 500. So it had, the new one was 1,000. A 2 years old Dell notebook is $500. Net realizable value, if I have this in my hand, now I'm not buying it, I'm selling it. If I want to sell it, Of course, in the market, they are selling it for 500. Do you believe they will purchase it from me for 500? Do you think I can go to the market and sell it for 500? 500, these shopkeepers are selling. If I go and I offer them this notebook, probably they will buy it from me 400 because they are going to put it for 500 selling. Understand?
So current cost is the current value.
Yeah, current cost and replacement. There is one more. Now, why did I say thank you to Roshan that you brought up a very interesting thing? Now, let me give you another example. Let's suppose that you have an asset which you purchased it for 1,000. And then you depreciated it for 200. And then you depreciated it for 200. 2 times you depreciated it. In your books, the asset is 600. Now, you know that asset values have gone up. And there is a similar asset, an asset which is probably a similar asset like this, which in the market now, the new asset in the market is actually 1,500. So if you start charging depreciation on 1,500, that would have been 300. 5 years depreciation I'm doing. 300 depreciation I'm doing. So actually, in my books, the asset had a net book value of 600. But because the new asset market prices have gone up, the current cost is 900. Do you understand this concept? I have an asset, I purchase it for 1,000. And 5 years life, 200, I'm charging depreciation. My asset had a net book value, carrying value, 600. That's very clear. But if I ask you that, don't tell me the net book value, tell me the current cost of this asset. So you would say, okay, this asset, when I purchased it, it was for 1,000 new. But now the same model is for 1,500 new. For 1,500 new, if I take out 2-year depreciation, 5 years, the current cost will be 900. So this asset actually has a current cost of 900.
But that 1,500 is the current cost, no?
No. 900 is a current cost. 1,500 is a cost of the new one. Yours is 2 years old. That is the selling, that is the price of the new asset. That is the price of the new asset. But you don't have a new asset. You say, you suppose it that if I had purchased it for 1,500 and if it had been depreciated for 2 years, it would have been for 900. We call it current cost accounting. We are not going to use it, but this is a way of doing things. This is another way of, restating your balance sheet.
But this doesn't seem realistic,
No, that's what I'm saying, that I'm not going to use it. But this is another way of restating your balance sheet. We are using this thing. But actually, this is very realistic, if you ask me. This is not realistic because if you see what is the market price, 1,500. If you have a new car, let me ask you a question now. You purchased a car for $20,000. You use the car for 2 years and you are charging, let's suppose, 3,000 depreciation. Now, you guys are going to tell me the truth, okay? Very honestly, 14,000. Then what happens? Car prices go up. The new car goes to 30,000. Are you going to still sell your car for this amount? Old car?
No.
Are you not going to think about the current cost?
Yes, we'll see the current cost.
You will see that, oh, the new, and that is why I have seen in many countries that people, they purchase car for 20,000. They used it for 2 years and they are selling even now for 22,000.
Yeah, this could happen.
I have seen this thing. I can tell you the name of the countries if you want. And that happened because of devaluation. Because what happened in a country, the currency was $1 equal to, let's suppose it is 3 certain. And the car price was 20,000. In the local currency, it was multiplied by 3, it was 60,000. Then what happened? That the dollar changed. And the government put taxes. So taxes and duties. And the guy who purchased car for 60,000, after 3 years, he's selling his car for 90,000. After using the car for 3 years, he's selling the car on 50% profit. I mean, it can happen. So that is just an alternative way of seeing the value of asset. I said that I'm not, under IFRS, we don't prepare it under current cost. We don't value assets on current cost, but that is just a concept to give you. Okay, so we actually have finished it here. This is end of this chapter. Now I'm going to move to this topic, which I told you, structure of financial statements.